Okay, so I'm gonna have to welcome everyone again onto the call because I forgot to start my recording. However, before I go on, I'm just gonna have to let you know that I'll be dealing with every single thing in my box today, where I've boxed on the chart on Euro and ZD, and I am also gonna be talking about Elliott wave, which is just a step up to the structure that we studied yesterday. Yesterday, I did talk about the creation of higher highs, lower highs, and the importance of breaking market structure to opposite directions. I did put on a little bit of trend lines. I did put on a little bit of channels, which are all the same stuff as some people know, some people do not know. If you haven't gone back to watch the video, please do so. The recorded videos are all in the group chat. Go back and do so. Today is just a step up. It might link in so easily with some of the things that some of you on this call already know. It might be totally new to you. However, I just don't want you to be worried at all because I'm just going to be talking about it in a very, very basic form. So if you look around this area of my trading view where I have my harmony pattern, this area below here, we have Elliott impulsive wave, Elliott triangle wave, Elliott triple combo wave, Elliott correction wave, Elliott double combo wave. It's a lot of complicated names. And then you're probably asking yourself, what is the importance of all these things? Are they needed in Forex trading? Do I need them in order to be able to trade? Well, the good news is I'm not going to be blowing your mind so much about all the four tools. The most important ones that you need in order to trade Elliott waves are just the Elliott impulsive wave, 1, 2, 3, 4, 5, and then Elliott correction wave. These are the sort of waves that you need. That's all. The rest of them, well, if you want to go extra detail of studying what Elliott wave is, which to me I think is personally not important at all, you don't even need it. Then you can go ahead and then learn about all of them. But the major ones that you actually need is the Elliott impulsive wave, the Elliott. Sorry, guys. All right. So before I stopped the recording, I was talking about the types of Elliott waves that you probably need in understanding proper market structure, which is the Elliott impulsive wave and then the Elliott correction wave. That is the two things that you need. Because basically, those are the things that happens in the market every single day, every single time frame that you go on. If you're able to understand what differences there are in this two different Elliott waves, then you probably have an understanding as to where you'll be taking your trades. Let's take a clear area where we can take some notes, guys. So don't forget the topic we're treating today is Elliott waves. And I have spoken about the two types of waves that are involved in Elliott wave. I talked about the Elliott impulsive wave and then the Elliott corrective wave. Now that we know the two differences, which is Elliott impulsive wave, Elliott corrective waves, what are they? What is the point? Why are they in the market? How do they look like? That is what I'm going to be talking about. So if we talk about the Elliott wave, impulsive wave, any impulsion in the market, just by the name, As the name sounds, you should know that any impulsion in the market is fast moving market. Number two, more of the same color, candlesticks. Number three, candles are usually fuller in body. And what do I mean by fuller in body? Almost 50%, almost over 50%, right, of the candle is a body. And these are the things that you need to be able to recognize in terms of trading Elliott impulsive waves. The impulsive waves are always going to be very fast, more of the same colors, candlesticks. The candlesticks are usually going to be fuller in body. Almost over 50% of the candle is always going to be a body. The rest, probably less than half of the candle, is always going to be wicks. So that would be the characteristics of an Elliott impulsive wave. We will go on the chart and then I'll show you some of the examples as to how they happen. And then if we talk about the Elliott corrective wave, number one, they are very slow. They happen slower. They are very slow compared to the Elliott impulsive wave, which I'm just going to put dot, dot, dot. I can't be asked to write everything. But in your note, please do so, just in case it helps you to remember. And then it's made up of, number two, it's made up of a mixture of different colors. Candlestick. So these are the things that you need to pay attention to. The Elliott corrective waves are most of the time very, very much different colors. So you see a bullish candlestick, you see a bearish candlestick following, you see a bullish, a bearish, a bullish, a bearish, a bullish, a bearish candlestick. There's a lot of them put together, but in the end, the good thing about it is it helps you to identify the structure that we are talking about. Are we taking some notes, guys? Please give me a 2 in the chat box if we're making some good notes right here. All right, good. So now if we look at the structure, of an Elliott wave, we always have a structure from a 0 to a 1 to a 2, 1 to 2, 2 to 3, 3 to 4, and 4 to 5. This is how they always look like. Let's stretch them nicely and tie in some of the information that we studied yesterday. If you look at the movement from the 0 to the 1, the 0 is almost like what we studied yesterday, and then we said is a high. 1 will be a low, 2 will be a lower high, 3 will be a lower low, 4 will be your lower high, and 5 will be your lower low. Whenever these corrective measures are happening in the market, they are followed by these ones, which is the Elliott correction wave. From the five, you usually have this. You always have the ABC, which is the corrective wave. Most of the time, this is always going to be less than 50%, as I explained yesterday. From the 5 to the A is always going to be less than 50%. But the movement away from A, which is the B area, is going to be a very strong movement that go past the A. And this is where we talk about corrective impulses in the market, right? It is so difficult to go by all this sort of movement in the market. How am I going to be able to identify this movement in the market? I believe some of us are already asking ourselves, how am I ever going to be able to identify this on every single time frame and trade it properly? It's actually hard, and I don't blame you for feeling that way. The only good thing about this is that you do not need to see all these shapes in the market in order to trade. No, you don't. However, the characteristics that I've given you will determine if you really are seeing an impulsive wave or a corrective wave. Now, let's go on a chart and then I'll show you some few examples. I told you we're going to be using this blue box. From the very top of this box, look at what's happening over here. Look at how first price was dropping. And most of the candlesticks over here, look at how big they are. All the way to that area. And when price got to that end, look at these candlesticks. They're very sad in nature. Sorry, I'm just trying to describe it by some of the informations that I've given it. It doesn't mean that they're sad. It just means that the body of the candlestick is less than 50% of the actual candlestick. So if you look around all this area, it's probably only this candlestick that is above. The rest of them, look at that. The bodies are very, very low. And that is your corrective wave inside this Elliott wave. Inside this impulsive movement, you always have that corrective wave. And that corrective wave is what yesterday I told you. If you pull a fib from the up to the bottom, you're looking for the prices to be around 50% and above, which will give you a true retracement and price will drop. And being able to identify this will actually give you the direction of the market. I'm only talking about pure market geometry. When it comes to smart money, we look at it in a completely different way, which I will be covering tomorrow. Smart money look at the market structure in a completely different way. It incorporates every single thing that I've spoken about already. However, with different kind of nomenclature. What do I mean by that? Different forms of names. Where we talk about accumulation schematic, the wake-up schematics, the distribution, the redistribution, they are all part of the Elliott wave. They are all part of the formations. However, you need to have the basic understanding of the market geometry in order to be able to understand why you are seeing that form of movement in the market. Either is a distribution, either is what do I call it? Accumulation. You need to understand where in the market these things are occurring. So in this case, looking at this leg right here, I can clearly identify that this was my impulsive move. Based on the characteristics of the candlesticks that I was seeing and how fast it was, how would I know how fast it was? See, if I pull my pip tool from here, from the very top to here, It's going to tell me how many bars that was involved and how many days or how many minutes that took this price action to occur. So in this area, I can tell that this was about 15 bars and it happened within 2 days and 12 hours. If I pull this one from here to there, look at that. This was 5 bars, but then it took 3 days and 20 hours. So this teaches you how fast your impulsive waves are going to be compared to the corrective waves in the market. If it's going to take you 3 days to be able to make, how many pips is this? This is about 231 pips. If it's going to take you 12 bars, 2 days to make this amount of pips, why would you want to be taking the trades that will last you over 3 days and 20 hours to probably make just about half of it? And this is the mistake that most of the time people are making. Not being able to identify which kind of wave that they are seeing. Is it a corrective wave or is it an impulsive wave? The best way to acquire most pips or to be able to get high probability trades is by catching the impulsive waves. If you miss one impulsive wave, it's just about understanding where in the market you are based on what we studied yesterday. Do I have a breaker structure? Indeed, if you look around this area, yes, there is a breaker structure. Yes, I do have it. So if I have a breaker structure and I have an impulsive wave, the next move that occurs is a corrective move. All I'm doing is I'm going to be waiting for 50% and above, a true retracement, and that's it. I'm going to short it again. One more thing, look at how many times we have black candlesticks. On my charts, I represent my bearish candlesticks are black. Look at how many times I have the same color. I rarely did have the bullish ones coming in. And look at how fast they were, how strong the bodies of the candlesticks are. But if you come around here, very slow with a very sad faces candlesticks. Are we learning something new here, guys? Is it helping? I don't know, but then it's very, very difficult, yeah, if you're not able to identify the differences of the ways that you're trading. You might be trading an impulsive, you might be trading a corrective wave, and then all of a sudden an impulsive wave happens and yeah, it hits your stop loss. And the sad news is you probably didn't even put a stop loss. And it goes so deep, into red, and you're wondering, why did this happen? Always check the move prior to where you're taking your trade. What is the difference between corrective and retracement? It's just the characteristics. The retracement is 50% and above on your fib level. Corrective, on the other hand, is just everything that I said over here, literally. So be able to list all these confirmations down in order to know where you are in the market and how you're going to take your trade. It's very, very important. Once again, if you look around here, every impulsive wave followed by a corrective wave is going to follow another quick impulsive wave. So if you look at this length, if I should clone this length right here and put it here, it should be almost about the same. And look at that. And this is what Delorean really teaches about. So for those of you wondering about, oh, I want to go and learn Delorean. I want to understand how Delorean really trades. Delorean understands the ways, and he understands what movements are occurring in the market. So he knows exactly where he's taking the trades from. If he picks up the trade from one side, it's going to finish off another side of the other half of the impulsive wave. So the impulsive wave that happens here, I am just going to clone it to the top of this corrective wave. And my TP should be almost about the same. So would you wait to see an impulsive, then corrective before entering the impulsive wave again? Why would you jump into a quick impulsive wave? That's the question I would want to ask you first. Because you don't know when it's going to finish. You don't know when that wave, that particular wave is going to complete. It's always clear to be patient and understand, but you know exactly where a corrective wave is going to finish. You don't know where an impulsive wave is going to complete, but you almost at least have an idea. You know the direction that you are in. My corrective wave is probably going to be a full retracement. I'm going to wait for 50% and above. And tomorrow we're going to be talking about some of the confirmations as to why you're going to be waiting for 50% and above. Look around this area where this wave went. Everybody that knows a little bit about smart money knows that this area was purposely made in the market. Why is an imbalance? Price just traded straight into the imbalance and it dropped. And that is just one of the confirmations you need. There are more to it. Once again, from here, look at what happened. And look at most of the candles over here, less than 50% of the body except around this area. And look at that, how quick it got violated. Broke the structure once again. Another impulsive wave. If I should fib this corrective wave, if I should clone this and put it here, it's almost just about the same leg. And this is what makes me understand that indeed I am seeing an Elliott wave. There is a structure to an Elliott wave that if I fib this area, most of the time, the second corrective wave is a bit longer compared to the first one. Most of the time is a bit longer, is a bit of a deeper retracement compared to the first one. And there you're going to have that structure. 1, 2, which is a corrective wave, 3, impulsive wave, 4, corrective wave, and then 5. And guess what happens over here? ABC. I didn't create this. I didn't create that. I can show you one more. Look around this area, the downward movement that occurred over here. I know this is my high. From here to there, corrective wave. From here to here, corrective wave. From here to here, A, B, C. We went up again. It's just the structure of the market, and you need to understand where you are in the market. You just need to understand where you are in the market and how to trade it. Simple as that. A, B, C. And inside these waves, if you go on smaller time frames, you're going to be seeing the same structures building inside that wave. If you do not know that this leg right here is an ABC corrective wave, and you fib right here thinking, oh, is a harmonic pattern sitting here, Okay, this is actually a back pattern. I'm going to take my entry at 88.6. Look at that. We went above 4. Why? Because it was a corrective wave. ABC must break the structure. So you know that your 88 entry is definitely going to be violated. However, your trade will still be valid. Price will go higher and come back down to your TP anyway. And this is why most of the people struggle to stay in harmonic trades. Because in the first place, they do not understand what structures they are within or what structures in which the harmonic patterns are being formed. Am I teaching somebody here? It's a bit crazy, but guys, trust me, it is everywhere. It is everywhere. Even if we should focus our attention within this structure right here, you're gonna see an Elliott wave playing out. But then the question is, do you see it? Now look, do you see it for yourself? A, B, C. And it's everywhere. Following that, we can go straight into another one. One, from the C, you're gonna have your next move coming down again and giving you the one. Sorry, I missed it out. Let's just take this out and then I'll start off again. What do you have here? A, B, C, and a drop. And it's just identifying the characteristics that I've given you, which is most important. Is the harmonic always at the end of an Elliott wave? No. A harmonic pattern is just formed within the Elliott waves. You can even see a pattern here from 1, 2, and 3. There is a pattern over there. But then it's up to you to know what pattern it is in order to be able to trade it, which we will explain. I will talk about it. See, it didn't break. Is it supposed to? See, it didn't break. See, actually did. Mars. See, actually did. So most of the time, you're going to see your reaction from the ABC always going higher from your Elliott wave. So this movement occurs day in and day out in your structures. Is the corrective waypoint B a fake break? That is where most of the time we are seeing the Wyckoff springs. OJ, that is where we are almost all the time seeing the Wyckoff springs. And this is why it's so important for people to understand the structure and what candlestick formations are playing out. I have a less than minute on this call right now, so I'm going to ask everybody to go off. And again, let's jump back on for the next session where we will finish up for today. In other words, yeah, they are in Wyckoff.